In this final lesson in our course on the merger model, we're going to take a look at some common investment banking interview questions on the topic of accretion dilution, merger models, synergies, and so on, and look at how you can properly answer these questions in interviews. Now, the most common question you can get on this topic is to walk the interviewer through the basic merger model. We've already been over that in the previous lesson, so I'm not going to repeat that here, but instead we're going to dive into some more detailed questions on the topic. After getting asked to walk through the basic merger model, the second most common question you can get is why would one company buy another company? So if you're the CEO of one company, why would you want to actually buy another company? And there are many reasons, but some of the most common ones are to capture market share. So let's say you're Microsoft. One of the reasons that they were motivated to buy Yahoo was to capture market share against Google in search engines. Another reason would be to capture additional growth. So maybe you're a very established company and your growth rate is no longer that great. Maybe it's 1%, 2% a year, something like that, and you want to increase your revenue growth rate by acquiring someone else who's growing more quickly. Another reason would be to gain the seller's customers. So maybe they have customers that you believe you can sell your products to or your services to, and so you want to get their customers for cross-selling or upselling purposes. Yet another reason would be that they have some type of critical resource or technology or intellectual property or something like that. So maybe an oil field is particularly attractive to your company because you're looking to expand to that region or because you believe it has great production capacity. Maybe the company has a really important patent and you want to acquire it. So those are a couple of reasons. Another reason could be that you believe you can easily establish some kind of revenue or cost synergies with the seller. So they have a very compatible business structure and you think that you can save a lot on expenses or expand revenue a lot by acquiring them. And then one final reason is that the seller may be undervalued. So maybe they're trading at $50 a share, but you think they're actually worth $100 a share. And if your company goes in and buys them, you can get a good deal. So those are a couple of the more common reasons that you might actually acquire another company. Another question here is what are the effects of acquiring another company like this? So when you have a merger model, beyond just walking through it, what actually happens in terms of finance? What are the effects of a merger or acquisition like this? I think there are really 5 main effects that you want to point out. The first is if you have cash, you're going to get foregone interest on the cash. If you have debt, you're using debt to acquire the company, you're going to get new interest paid on debt. And then if you have stock, you're going to have additional shares outstanding because you're issuing stock to buy the company. So those are the 3 main financial effects. Other effects would be combining the buyer and seller's income statement as we had right here. So actually listing a combined income statement for both companies. And then once you have that, you also have to remember to create new balance sheet items as we did right here. So those are the 5 main effects. Foregone interest on cash, interest paid on debt, new stock, combining the financial statements, and then creating new balance sheet items. Another question you can get is how can you tell whether an acquisition will be accretive or dilutive, whether it will increase or decrease the buyer's earnings per share? So for this type of question, if you're using all 3 purchase methods, there's really no rule of thumb that you can use. It's very hard to tell at a glance. But if you're using only one of these, so if you're only using cash or only debt or only stock, then there are tricks that you can use to tell. So to go to the cash example first, so what you want to do when you have all cash is look at the foregone interest on cash times your purchase price, and then compare that to the seller's pre-tax income. So in this case, we know that we're paying around $40 billion, a 1% foregone interest rate on cash. So if you think about the math there, 1% of around 40 billion is around 400 million. But our seller has 4 billion of pre-tax income. So we can tell at a glance that this is going to be accretive because we're paying so little in interest. And sure enough, it is accretive as we can see down here. Now in the case of debt, the same applies except the numbers are slightly different. So if we're using debt, we have a 9% debt interest rate. We know that 9% is close to 10%. 10% of the 43 billion here is around 4 billion. So this acquisition is probably neutral to EPS because the interest paid on debt is almost the same as the seller's pre-tax income right here. And sure enough, scrolling down, we see it's 0.6%, so almost zero, slightly accretive in this case. And then finally, if we have an all stock deal, we can use another trick, which is to look at the PE multiples of the buyer and seller. So just to do some quick math here. So for Apple, if we take their share price of 192 and divide by their earnings per share, it's around 16. For RIM, if we take their share price and divide by their earnings per share, so it's around 12.5. If the buyer's PE multiple is greater than the seller's PE multiple and it's an all-stock deal, it's going to be accretive because they're paying less for each dollar of earnings than what they're currently worth. And sure enough, when we look below, we see that it's accretive because Apple's PE multiple here exceeds RIM's PE multiple. Now, if it were the other way around, if RIM had a higher PE multiple, then it would be a dilutive transaction. So those are a few tricks you can use to tell what's going to happen when you have an accretion dilution model like this. Another question here is, what is the best way to purchase a company? So assuming that you have unlimited cash, debt, and stock, what's the best way to purchase a company? All else being equal, a buyer will always prefer to use cash because the foregone interest rate on cash is always going to be lower than the interest rate on debt. And if you think about stock, usually, as we saw in our WACC analysis for the DCF, the cost of equity for stock is usually at least 5 to 10%, and often more than that. In this case, it's around 12.5%. So the cost of equity also usually exceeds the foregone interest rate on cash. So all else being equal, the buyer will almost always prefer to use cash. On that note, you could also get asked about how you determine how much in cash, debt, and stock a buyer could actually pay. Because in this example, we didn't really go through this. We just assume that they can pay whatever percent we say right here. So for cash, this one's easy because obviously you cannot exceed the balance sheet cash number. But beyond that, companies also usually have a minimum cash balance. So normally you would go to the CFO and say, how much cash can you actually afford to spend? How much do you actually need minimum to keep running the company? For debt, you really have to look at comparable debt issuances. So you look at companies of similar sizes, transactions of a similar size, and figure out how much debt they've issued recently and use that to make your estimates. For stock, this one's tricky to estimate, but usually you don't want to give up over 50% of your company. So if you're issuing stock such that the seller will now own over 50%, then that can be problematic. So usually you don't want to dilute yourself and your existing shareholders too much with that, but stock is definitely the most difficult of these methods to estimate. But that's how you might go about it. You might look at how much you're actually giving up to the seller and see how your existing shareholders are going to react. Another question here is, how do you determine the purchase price to pay for the seller? So in this case, we just had this assumption of $75 a share, but how would you actually determine this? So for this question, what we would do is just go through a valuation, much like we did for Apple right here. We would simply use all three methodologies to value the company and go with that. Now, if you have a public company, it's going to be based on the company's share price and a premium to that. A deal is not going to get done if you go in and offer them $50 a share and they're currently trading $60 a share. With a private company, by contrast, you really would just use the valuation methodologies and you would base it on what they say and what the company has previously been valued at when they've raised funding or done some kind of other financing, for example. Another question on the topic of purchase price and methods of payment is, what happens if, let's say, Apple goes to acquire RIM for $43 billion, and then the next day the market hears about it and decides that RIM is actually only worth half of that, so around 20 or 22, 23 billion. So to illustrate what happens here, let's change this to a 100% stock deal. And we're going to say that the market decides they're worth only half of this purchase price. So Apple's share price would simply fall in proportion to that. So if we take this 192 and then we subtract by this price times the percentage of value that this represents. So 21 divided by 176 right here. We see that Apple's share price here in this case would fall to around 168 should the market decide that RIM is only worth half of what they're paying for it. Be careful with this question because a lot of people will get confused and think that Apple's share price or the buyer's share price would actually be cut in half, but that's actually not what happens. The share price falls in proportion to the difference in value. Another question here is, how are merger models actually used in valuations? So going back to our valuation page, if we went in here, how could we actually use a merger model in this case? So what you usually do for this type of scenario is you go to the merger model and you go to the bottom and you set the accretion dilution here to 0%, and you work backwards from this 0% assumption to figure out how much the buyer could actually pay. So in this case, we would back solve and get to a per share purchase price that's implied by a 0% accretion dilution. We can also use it, for example, if we want to say how much could they afford to pay to achieve 1% accretion or 2% accretion with certain assumptions for synergies. So we use it as sort of a what if analysis and say, assuming a certain accretion, dilution, and a certain amount of synergies, how much could the buyer actually afford to pay? And then we would go back to our valuation graph and simply list the share price right there. Another common question here is why is it that we create goodwill and intangible assets in an acquisition? We've already been over this one, but just to review, the reason this happens is because oftentimes the seller's shareholders' equity, their book value right here, around $7 billion, is significantly less than what the buyer is actually paying, the $43 billion right here. So to plug that hole, we need to create goodwill and intangibles. You may get asked what the difference is between goodwill and intangibles. The difference, as we saw here, is that goodwill does not amortize at all, so it doesn't amortize over time. Intangibles, by contrast, do amortize. Goodwill represents assets that are going to last for a long time, conceivably forever, whereas intangibles represent assets that have a fixed lifespan and are going to be worthless after a certain amount of time. Usually goodwill is also much larger numerically versus intangible assets, so the majority of the purchase price is usually allocated to goodwill and a much smaller percentage goes into intangible assets. Another question on this topic is why do you have asset write-ups in a merger model, in a deal like this? The answer is because oftentimes the values that are listed on a company's balance sheet for assets and even liabilities sometimes are significantly different from the true market values of those. And so when you have an acquisition like this, you often adjust and you call in auditors and accountants and other people to adjust the values and match them to what the market thinks they're actually worth. You get a deferred tax liability because oftentimes when you make those adjustments and you mark up the value of intangible assets or of PP&E, for example, you're doing that for financial reporting purposes, but you don't do it for tax reporting purposes. And so on a tax basis, these values have not changed. As a result, you get this deferred tax liability getting created right here. You could get asked about other acquisition effects, even beyond the ones that we went over. And there are many that you could go into, but two of the more common ones are deferred revenue write-off. The reason this happens is because remember that deferred revenue is cash that a company has collected for services that are going to be performed in the future, so they have not yet actually officially recognized it as revenue. Now, the reason you would write it off in an acquisition is to avoid double counting. The timing of acquisitions like this can be very tricky, and so oftentimes when you acquire a company, by the time that you've actually acquired them, they have performed the services, and so if you brought over the entire deferred revenue balance, you might actually be double counting it. So oftentimes you write off a certain percentage of the deferred revenue. Another acquisition effect are intercompany receivables and payables, and specifically writing down intercompany receivables and payables. What this means is that if you go back to the balance sheet, Apple and RIM may owe each other a certain amount under accounts receivable and vice versa under accounts payable. But when they combine as companies, it no longer makes sense to record entries for those types of things, so you'd actually write down part of the balance. And so when you write down the intercompany accounts receivable or intercompany accounts payable, it's going to reduce those items on the balance sheet. One final topic that you may get questions on is the concept of synergies. So the most basic question is, what is a synergy? And can you give a few examples? So synergy is just a situation where 1 + 1 = 3. So you add up two companies' financials and you get more than you bargained for with revenue or less than you bargained for with expenses. The two most common examples are revenue synergies and cost synergies. With revenue synergies, the most common scenario is cross-selling or upselling to existing customers. So you have a company's existing customers and you can sell your own products to them now, or you can sell higher priced products to them. So those are examples of revenue synergies that you could attain. The example we went through here is, let's say that Apple made its iPhone apps available for BlackBerry. So that would be an example of revenue synergies for this type of deal. For expense synergies, examples would be laying off employees, consolidating buildings, reducing manufacturing costs, And these happen because oftentimes a company's G&A employees, especially, so anyone administrative, is often redundant. Buildings can also be redundant if they happen to have headquarters in the same location or an office in the same location. And sometimes they can reduce manufacturing costs by adopting the processes of the other company. You may get asked which of these is taken more seriously, which one is more important. The answer here is expense synergies, because you're working with real numbers. The problem with revenue synergies is that it's very difficult to estimate how much you can actually achieve, whereas with expense synergies, at least you're working with real numbers from the start. So you can say, we're going to eliminate 10 employees, or we're going to consolidate these buildings, and you can at least estimate based on existing real numbers. But with revenue synergies, it's just too hard to predict into the future what is actually going to happen when two companies merge like this. You may get asked what the effect of synergies on the merger model is, and the answer is that synergies are always going to boost your accretion dilution, so they're always going to make a deal more accretive. They're always going to boost the combined company's earnings per share. Then one final question you can get is, how do you display the output from a merger model like this? And similar to what we did with the DCF analysis, where we had our sensitivity tables there, what you do with a merger model is do a similar type of sensitivity table, and you would look at various inputs such as purchase price, cash versus stock versus debt, and synergies would be the most common ones. And you look at these variables and you create some type of table to analyze what happens at different prices, at different transaction structures, and at different synergy levels. So those are some of the most common questions you can get in interviews on the topic of merger models, accretion dilution, synergies, and so on. If you understand everything that we went through in this course on the merger model, you should be more than well prepared for interviews, because some of this material actually goes beyond common questions, especially with the goodwill creation and some of the tax liability stuff that we looked at. So if you've made it this far, you should be in good shape for interviews, because much of this model actually goes beyond what you're going to need in the typical interview. So that's it for our coverage of the merger model. Coming up in the next course, we're going to be looking at the leverage buyout model. And we'll be extending our analogy of buying a house to the leverage buyout. We'll look at it conceptually, and then we'll go through a couple examples of how you can actually create a merger model, both a really basic one and then a merger model that is more advanced and something that would be more appropriate for private equity interviews.